Hello and welcome to Earnings with ET Now Special. I'm Nikunj Dalmia. As we reach the midpoint of this earnings season, it's time to take stock and analyze how companies and how India Inc. has performed this time. Is it another quarter of weak growth, or now green shoots of recovery are clearly visible? So that's the talking point. We'll analyze pretty much all the large companies which have come out with numbers, what has been the management commentary, and how should one really read into the fine print. Let's just quickly look at the basic headlines which we've got from this earnings season. 15 Nifty 50 companies so far have come out with numbers. The big hurrah is Reliance. Reliance refining margins, they now stand at a 7-year high north of $10 per barrel. Large cap IT companies have come out with decent set of numbers. So numbers for Infosys and HCL Tech have been in line with estimates, and the management commentary for the second half of year is quite constructive, particularly from HCL Tech and from TCS. IndusInd Bank and HDFC Bank numbers are in line with estimates, whereas Bajaj Auto and Hero MotoCorp has reported a stellar expansion in margins. HUL surely surprised everyone with a 6% uptick in volume growth, but demand is subdued. Margins are under pressure. Commodity deflation has not really benefited them. And Z has reported one more quarter of extraordinary growth, largely because of business which is now coming from the e-commerce business. There have been some disappointments as well. What we've flagged off so far are large cap companies where numbers have been strong, but the big eyesore or the big howler was Federal Bank, which came out with extremely poor set of numbers. NPAs have gone up, which means bad loans have gone up. Credit growth is not there, which means they are not able to really monetize more business from new clients or existing clients. DCB change in business plan, markets are not very impressed with that, and Cyient also has some basic issues about their delivery model. So I'll take a deep dive. Let me bring on board our researchers who will walk us through the real earnings scorecard and how individual sectors have performed. And Ajay, the headline clearly is Reliance Industries. GRMs, they stand at a 7-year high, and markets have given Reliance Industries or that stock a double thumbs up post numbers.
Well, that's correct, Nikunj. In fact, out of the 15 Nifty companies which you were talking about, this one was the biggest surprise so far. This time around, they came out and surprised the street, which was actually expecting a subdued quarter on the GRM front with a massive $10.5 kind of a GRM performance. Not only that, the petchem end of the business also saw expansion as far as the EBIT margins are concerned. So confidence seemed to be coming back in Reliance Industries, and earning estimates have moved higher. You talk of CLSA, Citi, Barclays, almost every large or small broker on the street has really upgraded the estimates, saying that a lot of capex from now on will come on stream and hence will aid overall profitability. So this one definitely has been supporting the market ever since that strong outperformance came in this quarter, and a lot of hope is also getting built in that if Nifty has to move higher, Reliance's support will come in because earnings are gradually coming back.
I would say extraordinary set of numbers, but clearly an all-round beat from Reliance Industries. Pranay, over to you. It's 4 on 4. IT companies have come out with numbers which are in line with estimates, but the management commentary was clearly divided.
Absolutely, Nikunj, and it's been a mixed bag that we've seen so far. So Infosys, the IT bellwether, posted a very strong set of numbers, positively surprised the street, but reduced its guidance in the dollar terms by 80 basis points to come in at 6.4 to 8.4%, and that is something that the street did not like. If you look at TCS, their numbers were in line with the estimates. The management was gung-ho about the order book, which has reached a new record high, 30% higher than the previous record that they had set. Digital as a proportion of the revenues contributes about 13%. They expect this to reach over 15% in a year and maybe 20% in a couple of years. So it's growing very high. And out of the three problem areas that they have, LATAM, Japan and Diligenta, it's Diligenta and Japan which will remain weak for 2 quarters. LATAM has started to work very well. So analysts are saying that perhaps the multiple of 20 which has been given to it should be reduced to 18 because it's expected to grow at a similar pace as Infosys. HCL Tech was the other one which had already given out the earnings warning. So the momentum, the softness in the momentum was expected, and analysts say the company's made a bottom in terms of margins at 20.6%. Second half growth is going to be very strong. They've got over $1 billion worth of contract engagements that they've signed, and the management reiterated its 21 to 20%, 22% margin guidance. Lastly, Wipro is the one which has posted the softest result that we've seen compared to expectation. It's been in line, but the commentary is very weak for Q3. So mostly 3 out of the 4 companies have said that because of seasonality, Q3 growth is going to be soft. Only TCS is one which is saying that H2 growth is most likely going to be stronger.
Thanks a lot for that. Yatin, first it was Hero MotoCorp, then Bajaj Auto, margin expansion is solid. What's going on? For the longest time, markets have been arguing that two-wheeler sales are under intense pressure because rural economy or the agrarian economy is slowing down.
Well, Nikunj, let us break this, auto result for our viewers much more simpler. If you look at auto companies, the typical high cost is on the commodity front because a lot of commodities go into making, a vehicle, be it plastic or be it metal. And given the fact that in the second quarter we saw lower commodity costs and most of the auto companies did not pass the benefits to the customers. In fact, they retained that benefit, and that is the reason why we are looking at better margins coming in for all of these auto companies. If you look at Hero MotoCorp, clearly surprising on the margin front, the margins coming in at 15.8% versus the street expectation of close to 14.5%. And if you look at the profits also, despite a 7% decline in the volumes, we saw profits growing by almost 2 percentage points. So despite that challenge, Hero MotoCorp has been able to maintain the profitability. Ditto is the case with Bajaj Auto. We have seen the motorcycles market suffer because of weak rural demand, but that is offset because of higher exports in the three-wheeler segment, and also because of lower commodity costs, they have been able to garner better margins. In fact, margins for Bajaj Auto came in at 21.6% versus the street expectation of again 20.5%. So clearly, both these two-wheeler companies have been able to surprise the street on the operating performance, and going forward also the management is hopeful that in the second half the margin recovery and the volume recovery would happen.
Let's talk about financials, and Poonam, let's divide the financial space into 2 parts, which is NBFCs and banks. And within banks, the big boys have delivered. HDFC Bank came out with good set of numbers, can't complain when it comes to HDFC Bank, but Federal Bank and DCB, what's going on? One bank is under pressure because of NPA, other bank is feeling a heat of new competition.
Well, in terms of the banks, IndusInd Bank posted very strong numbers, HDFC Bank in line, DCB as well as Federal Bank did disappoint slightly. First, in terms of IndusInd Bank, strong profit growth supported by even stable asset quality. Margins have expanded nearly 20 bips on a sequential basis, and the loan book growth did come in at 30% inclusive of the diamond book that they recently acquired. Management does state that the kind of margins at 3.88 are not sustainable, but having said that, they would still be able to maintain the margins in their earlier historical trajectory, and they also plan to announce base rate cut anytime. Also, they do plan to maintain their growth rate at 25 to 30%. It remains a top pick from CLSA. HDFC Bank results in line, although the gross NPAs are stable on a sequential basis. The GNPAs have inched up 5% quarter on quarter. Very strong advances and deposit growth continue. Management does state that margins will be in the range of 4.1 to 4.4%, and they do intend to revise base rate during third quarter. In terms of Federal Bank, again, we did see the entire stock coming down on account of very high NPAs. NPAs rose nearly 15% QOQ, highest in the last 8 quarters, and that led to the disappointment on the profit as well as in terms of higher provisions. A slew of analysts have cut target price multiples as well as earnings estimates on Federal Bank. DCB, although the results were not as disappointing, but their guidance did disappoint the street very badly. Their earlier guidance was to open 150 branches in 24 months, as they do anticipate rising competition from small banks and payment banks, but that did not go well, and most of the analysts in fact downgraded the stock to sell and cut their earnings estimate. That led to in fact management again recalibrating their guidance to opening of 150 branches in 24 months, and they have now stated that they would be going in a calibrated manner on branch expansion.
Okay, so the big story clearly is that so far earnings season is not off to a great start, but numbers have not been disappointing either. Reliance has been a complete success story. TCS management commentary is indicating that better times are coming ahead. Infosys is still sounding reasonably confident of the IT environment, and HCL Tech has openly admitted and indicated that Q2 may not be the clear benchmark of what the company could deliver and indicate going forward. So IT is important. Since the four heavyweights have come out with the numbers, let's hear out from Amey Hatangdi of Morgan Stanley on what he makes of the current environment of the IT sector.
Less volatile, less fragile, hopefully, than in 2013, and in that sense probably more prepared for a crisis. But that does not mean that we are going to be decoupled, fully immune, not see any volatility at all. That's not going to be the case. So I would actually say IT and healthcare in that sense are doing relatively better than many other pockets in the economy that are dependent on exports. Purely from a high base, we are seeing the growth numbers slowing down. That's clearly evident from the numbers reported so far.
Well, let me also bring on board Vivek Mahajan, Head of Research with Aditya Birla Money. Vivek, good evening. Thank you for joining us. Earnings so far, how would you rate them?
Clearly, the earnings have been mixed. You rightly said that Reliance surprised a big margin expansion as far as Bajaj Auto and Hero MotoCorp were concerned. They also surprised the street, and of course IndusInd Bank and SDFC Bank, they came out with the results in line with the expectation. Hindustan Unilever was a disappointment, though they may have grown at the volume growth was 6%, but clearly they were trying to go for volume growth rather than margins, and they clearly have compromised on the margin front. So I will say a mixed bag as far as the large cap companies are concerned till now.
A mixed bag, but bear in mind that earning expectations are very, very muted. Markets are not expecting any jackpot numbers. So anywhere where there has been an incremental surprise, markets have clearly rewarded those stocks. And a case in point here is Reliance on Monday morning. It appreciated by 50 rupees plus because numbers were strong. On on Wednesday, it was the Hero MotoCorp which reacted to numbers, followed by Bajaj Auto. So wherever there has been a result surprise, markets are clearly rewarding those numbers. And Ajay, HUL, volume growth is impressive, but volume growth is coming at a time when generally consumption patterns are slowing down. And also, Ajay, the challenge for HUL clearly is that the commodity deflation is not translating into a huge margin gain.
Well, that's correct, Nikunj. In fact, you know, what is even more interesting this time around, that they tried to put a very brave face on the volume front, but they could not do anything from the competitive pressures from P&G. They had to take big price cuts this time around and could not even retain those price cuts in their margin. In fact, they had to, you know, that's why the on the top line also there was kind of a lower than estimated performance. Bottom line also got hit. So the benefit of commodity prices coming down in a way were given away to the consumer in the form of competitive pressures. That was the kind of pressure the company was. And the management commentary also was not very, you know, encouraging. They acknowledged the rural slowdown, urban pickup on the slower side. So really a big question is how they will continue on the volume front, because it's kind of a, you know, it's like a race on which they are limping on one foot alone, and that's why the valuations also becoming slightly on the higher side.
Vivek Mahajan, my specific question to you is on HUL. Do you think best of the gains for HUL for the year, are they behind us? Do you think HUL now runs the risk of underperforming markets?
Actually, HUL has underperformed the market for a very long time. We had seen a big up move when we saw the company increasing the stake. Since then, the performance has not been very exciting, and the stock has underperformed some of the better market players. You talk about Dabur or you talk about Britannia. Clearly, this company is losing out on the marketplace big time, and we do not have any confidence in the stock also going forward.
Big question mark on HUL, because HUL is expensive in terms of projected growth and in terms of the general environment where volume growth is unlikely to pick up because large part of the agrarian economy, the rural economy is still under pressure, and HUL still derives lion's share of its business from the agrarian stroke the rural economy. If there is one success story in this earnings season, that has to be Reliance. But as a group, it is NBFCs which have reported good set of numbers. The logic is very simple. Interest rates are coming down. NBFCs, they borrow in the wholesale market, they lend to the retail market. So the spreads which some of the NBFCs have enjoyed for the quarter gone by is relatively rich. Also, companies like Bajaj Finance and to a large extent Dewan Housing Finance, they've managed to gain market share. Bajaj Finance has gained market share because banks are vacating the entire consumer durable business. Dewan Housing Finance is gaining because PSU banks are suffering in the entire HFC market, so to speak. So Poonam, NBFC, what is the headline there?
Well, in terms of NBFCs, Bajaj Finance did post again a spectacular quarter, but Mahindra & Mahindra Finance did disappoint once again. In terms of Bajaj Finance, strong profit growth at 42%, AUM growth at 36%, and they continue to post over 30% AUM growth at least in the last 20 quarters. Stable asset quality. Management, however, states that if at all the festive season is good, they will continue to post 30% AUM growth, but they do remain cautious in terms of the loan against property book, which forms nearly 25% of their entire mortgage portfolio. As a result of that, they are stating that they are seeing some challenges on the LAP book, asset quality and margins. Credit Suisse has raised the target price to 5,000 again for Bajaj Finance, and also they have increased the EPS estimates. In terms of Mahindra Finance, profits were pretty much below the estimates on higher provisions. The asset quality has disappointed very badly. In fact, if you look at the GNPS, an inch up of GNPS to 9.4%. This is the highest amount of GNPS in many quarters coming in for Mahindra Finance. And
Vivek, we've got numbers from nearly half a dozen NBFCs. Which one or which NBFC to your mind has delivered?
Bajaj Finance, of course, came out with fantastic numbers, continues to be on our buy list. And in housing finance, the numbers from Dewan Housing Finance were very good. Definitely, the company should be benefiting going forward on account of the fact that their average ticket size of the loan is something like 1.1 million, that is 11 lakhs. And we are going to see a lot of growth coming in a small and mid-size housing segment. They are catering to, in a major way, to tier 2 towns as well, and significant growth expected to come from that quarter. Government's push on housing for all should also benefit this company. So Dewan Housing Finance also continues to be on top of our recommended list.
Bajaj Auto and Hero MotoCorp, we've discussed these numbers at length, but Yatin, I want to come back to you and talk about valuations. Post the earning adjustment in Bajaj Auto and Hero MotoCorp, which stock is cheaper?
Well, it has to be Hero MotoCorp, given the fact that the export market in which they are looking to enter, that will provide a growth opportunity. And also, if you look at the new launch pipeline for Hero MotoCorp, the kind of investments that they are making with their dealers, going forward, you know, the kind of growth rate the market is expecting is much more better and less volatile for Hero MotoCorp versus Bajaj Auto. Bajaj Auto has a lot of moving parts, be it the export markets, be it the currency, and be it the rural market, the urban market, and also if you look at the pricing, that has been quite aggressive from Bajaj Auto. Also, if you look at the silver lining for Bajaj Auto, they have a lot of new products lined up, but purely on the valuations, you know, Hero MotoCorp is something which is much cheaper versus Bajaj Auto, and clearly most of the auto analysts also we speak to are recommending or preferring a Hero MotoCorp to Bajaj Auto.
Vivek Mahajan, comment on this good old debate, Hero Honda versus Bajaj Auto or Hero MotoCorp versus Bajaj Auto. Which is a better one, because they may be making two-wheelers, but they both cater to different markets, different geographies and different categories of bikes.
Yes, I agree, but I have got a different view altogether on both these stocks. Both do not figure in my scheme of things, and as far as I am concerned, both Bajaj Auto and Hero MotoCorp continue to remain my top sells. The reason being, both Bajaj Auto moved out of scooter segment, a segment which is actually seeing a significant growth, and they are losing out on that front. Hero MotoCorp has somehow admitted that they are going to face a lot of competition from the multinational players, be it Honda or for that matter now Yamaha and Suzuki, though small but are stretching their muscles significantly in the domestic marketplace. As a result, both are today focusing on international market. Bajaj, yes, has faced some successes on that, wherein exports constitute nearly 45 to 50% of the company's turnover. Hero MotoCorp is also focusing on international player, focusing on African and Latin American markets. But my concern over there is these are very hostile economies, hostile in the sense that the volatility in the currency space is very high, and we do not know how the things are going to pan out. Headwinds from the currencies are going to be significant going forward. I would not like to venture in that space. Local market offers humongous potential. Hero MotoCorp has been focusing on rural place, but we are seeing that as far as Hero MotoCorp is concerned, for last 2 years or thereabout, the volume is static between 5 to 6 lakh numbers. Yes, there could be some pickup in the volume on account of festive season. Now we have got a festive season round the corner, we have got 7th pay commission coming in. That may lead to some sort of volume growth, but my belief is both will continue to struggle on volume front and as a result I think there are better players in the marketplace and I will not touch either of them.
Well, for the longest time we've debated Bajaj Auto versus Hero Honda. Now Vivek seems to be making a case that it's two-wheeler versus four-wheelers. Avan, over to you for some mid-cap companies which have come out with numbers.
It's a lot of mid-caps that have stolen the show this time when it comes to earnings. Start off with Emphasis then. An impressive set of numbers is what the company delivered. The consolidated profits jumped almost 20% to 185 crore rupees on a sequential basis. The net sales growth also was up about 4% at 1,555 crores. And you did have the operating margins which came in at 13.9%, but what the street clearly read into was the fact that the management has gone ahead and upped the second half margin guidance to 13 to 15% from an earlier 12%. Meantime, you had Hindustan Zinc from the metal space which put out sales which were higher by 4%. Margins came in at a steady 55% versus 53%, and the profit growth was good at 2,285 crore rupees. The other income was significantly higher by 25%, although the tax expenses too did jump quite a bit. Motilal Oswal then was another outperformer when it came to earnings. Consolidated income from operations came in higher by 46% at 259 crore rupees, and even the profits were fairly steady, higher by 33% at 43.4 crores. The other one was something that we don't discuss often, DIC India. A spectacular set of numbers on pretty much all parameters, particularly the top line growth, which shot up to 191 crore rupees versus 183 crores. The number that the street clearly read.
Right, Aman, thanks a lot for that. Pranay, literally 30 seconds to answer this one. Give me a company from the mid-cap IT space which surely has surprised everyone on the upside.
It's actually difficult to pick one outright because again things have been mixed, whether some companies posting good numbers or some posting good margins. So honestly I can't think of one, but I can tell you one that can surprise, and that is Majesco, which was demerged from Mastec. Its revenue growth is expected to be much higher than the industry, upwards of 20%. Margins are also at the higher end, mostly in gross style, and also they've been doing a lot of sales activity, very good hiring in US, so front end is pretty strong, just like what Intellect has been doing for the last 4 or 5 months. So you can expect similar performance coming in from Majesco over the next 1 year.
Well, at this point in time, let me thank all our researchers, Ajay, Poonam, Yatin, Avan, Pranay, thank you for joining us, and thank you for explicitly outlining how individual sectors have moved. So the sum and summary of earnings season so far clearly is that there is no clear trend. It's pretty much like a mixed bag. Reliance clearly is in a pole position post their strong Q2 numbers. Margin expansion is strong and solid for Hero MotoCorp and for Bajaj Auto. IT in at large, numbers have been in line with estimates, and for HUL, volume growth is impressive, but commodity deflation has not really translated into a great bottom line gain. We can always talk about some big howlers and some big eyesores like Federal Bank and the DCB, but in general, market expectations are so diluted that I don't think we will see any big earnings driven rally in the market, at least in the short term. Also, it's good to see that markets are rewarding companies when numbers have been strong and markets are punishing stocks when numbers have been poor. Vivek Mahajan, I'll take a moment to thank you as well for joining us. And before we wrap this special edition of earnings call, let's hear out top market voices on what they've made out of Q2 earnings so far.
Earnings for this quarter is not likely to be very exciting on an aggregate basis, but there will be a lot of fireworks on the positive side, and there will be a lot of disappointments. I mean, particularly in the commodity companies and all, a lot of companies will declare losses which will be way beyond most of the analysts' expectations. So we will have a two spectrum. There will be companies which will benefit from the losses of the commodity companies, and there will be companies. So those companies will show massive jump in the market operating margins. So the total declared profit could be up by 50, 60, 70% for few companies, and there will be companies which might see 80, 90% correction in the profits, or maybe a lot of companies will go from profits to losses.
The earnings season is something which is going to disappoint for this year. So if you look at where FY15 left us and the kind of expectations that most analysts had for FY16, earnings growth is going to continue to be actually on a higher trajectory later on, maybe in FY17 and thereafter. Then this market may appear to be expensive, which might be a trap for most investors.
The things which have not done well are all the domestic economy plays. So some of them have started doing well now in the last 1 year. Autos have done well, but it's the rate sensitives which could be the biggest drag. I would say over the next 3 years, IT is not going, like over the next few months I like IT because it's one pocket where valuations are not very expensive and you things which will come, domestic story. So we'll have this thing where when you have a change in sector leadership, it happens slowly and it keeps happening. And people, because you have earnings which are going to pick up, but till you have signed that this earnings is picking up, that you always have doubt. Sometimes people call it too early. So like a year ago people said earnings pickup is happening in 6 months, and that 6 months is probably going to get delayed by 1 year or by 18 months.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.